Well, concerns over China's recovery are growing. Imports and exports for the world's second largest economy fell in July at the steepest pace since February of 2020. Now, China's imports are down more than 12% in the last year, and exports contracted 14.5%. The grim trade data continues to fuel Wall Street's expectations that China's economic activity could slow further in the third quarter. Well, our next guest just helped publish the Guide to China. Joining us now is Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Great to have you on the show here. So, looking at some of the highlights from this China guide here, I mean, we're seeing obviously the US dollar rallying on some of the weakness that we saw in China's exports and imports. But give us an idea of some of the data that you're focusing on at the moment as investors try and wrap their heads around this recovery from post-zero COVID that just doesn't seem to be taking hold.
Thank you, Rachelle. Good to be on. And we created actually this Guide to China a couple of years ago together with our colleagues in Shanghai and Hong Kong because there's a lot of noise around China usually. So it's really a way to focus on the signal. And for this year, for China's recovery, it's really important to remember that this is the first time this is a China recovery that's expected to be led by domestic demand, not external demand, and by household consumption, not infrastructure and manufacturing. So the places we look for confirmation or lack thereof of that recovery are different. It's a very unique recovery. So from the report this morning, for example, I would focus less on the exports. Those were always expected to subtract a bit from Chinese growth this year. We're buying less stuff, right? Apparel and electronics. And I would focus a lot more on the weakness in imports, double what was expected for July. That's a signal that domestic demand is not picking up as expected. So really that's our focus. Where do we look for an eventual bottoming in domestic demand? And that's especially more related to household consumption and confidence, which could be a forward-looking indicator of whether we get a bounce back in the second half.
And that really does speak to President Xi's dual circulation strategy. They wanted to be less reliant on some of these foreign imports, more reliant on domestic consumption. But China historically is a nation of savers, and they don't seem to be buying into that consumption narrative. What are you finding as you dig into the data?
So it's really interesting. As you say, Chinese households are savers. They tend to save historically about 35% of disposable income. That compares to the US, for example, where we save about 7-8% on a normal year. So structurally, they're bigger savers. And to try to change that mindset in the long run, China really needs to build a social safety net, for example, so households don't have to save so much themselves. But I think for this year, what's also going on is that households had built extra excess savings during the 3 years of the stop-start zero COVID policy. So there's about 3 percentage points extra in savings as a percentage of disposable income. One way we look at that in the report is by looking at household deposits at banks, which doubled over the past 3 years. And what we're seeing is households are getting out and about. Mobility is back to normal, but they're not spending as much as we expected. It's very, very targeted on things like what we would call catering, so restaurants, also travel and leisure. But the spending has not broadened out further, especially not related to anything related to the housing market. So things like furniture and decorations, electronics, appliances, that hasn't picked up yet. So the linchpin really for this year to unleash those pent-up savings is household confidence needs to pick up, and specifically around the housing market. So that's where policymakers are focused on next.
And as we look at how investors are viewing this, I mean, when you look at some of the deflationary pressures that either people are trying to manage right now or that they're bracing for, what should investors keep in mind? We're going to be getting even more inflation data also coming out this week from China.
Indeed, we will probably get the inflation data overnight, and we might see a deflationary print year over year. And this is really a reminder to investors that there are a couple exceptions to this high inflation, monetary tightening narrative that we have around the world for the past year and a half. And that big exception is China. China has not faced inflationary pressure, and it's actually doing the opposite. It's providing monetary and fiscal stimulus in order to boost the recovery. It was already doing that going into this year, but it's picking up even more given that the data around domestic demand and confidence has disappointed in the second quarter. I think what investors got excited about over the past couple of months, when Chinese stocks have rallied about 10% since their late May lows, is that Chinese policymakers are now getting even more targeted with their stimulus measures because they understand they need to boost confidence. So they're engaging the private sector more. They're announcing the end of regulations that they were doing, especially around the tech sector. They're trying to provide stimulus to households to buy big ticket items like electronics and electric vehicles. And lastly, what investors are watching this month are policy measures around real estate to try to arrest some of the recent depreciation that we've been seeing, not just in activity, but in home prices. That's really a linchpin. That's what can sustain the recovery, not just in China's economy, but in Chinese markets in the second half. And we do expect that to happen and to be a positive tailwind.
And we did note that although we see a lot of talk about, at least in the media, about companies pulling out of China, didn't seem to see that quite as reflected. There was obviously some downturn in terms of the people that were surveyed, making some considerations about moving operations from China. But it does seem people are still in China for the long haul when it comes to at least conducting their businesses. For global multinationals, for investors in those spaces, what's one thing they should keep in mind?
I think it's a big rethink of how companies think about China. It used to be made in China to export to the rest of the world. Now it's made in China for China. So companies are not leaving China altogether. They're leaving their manufacturing there where the end consumer is the Chinese. And remember, this is still the second largest consumer market in the world, where consumption growth contributes about a quarter of all global consumption. And that's only set to increase as China is expected to double its GDP per capita, bringing another 400 million people into the middle class over the next decade. So really what companies are thinking about is, if my end consumer are Chinese consumers, I'll keep that production in China. But with my new production, if my end consumer is somewhere else, I'll have a China plus one strategy. And that's where opportunities are already picking up for places that can absorb that production. And we see interesting opportunities, for example, in Vietnam, India, Thailand, and Mexico that can pick up some of that overflow from China.
I do appreciate you joining us with that fresh report out this morning. A big thank you there to Gabriela Santos, JP Morgan Asset Management Global Market Strategist. Thank you so much.
Thank you so much for having me.